Cost modeling serves as a critical component of financial management, enabling organizations to analyze and optimize their expenses associated with processes, products, or projects. At its core, effective cost modeling empowers decision-makers to assess various options, identify sources of expenses, and uncover areas for improvement. However, the intricacies of cost modeling can often render the process tedious and complex. It requires a solid grasp of fundamental principles and the ability to apply these principles to specific cost models. To navigate through these complexities, we will delve into the three core concepts essential for effective cost modeling: cost classification, cost behavior analysis, and cost allocation methods. Cost models are foundational tools that help organizations understand, analyze, and predict their expenses. They serve as navigational aids, enhancing resource allocation, strategic decision-making, and overall operational performance. By categorizing costs effectively, organizations can gain a clearer insight into their expenditure structures, allowing for targeted cost reduction efforts and optimized resource strategies. The first core concept revolves around the categorization of costs. Understanding the different types of costs is paramount. Direct costs are expenses directly attributable to the production or provision of specific products, services, or projects. These costs are easily identifiable and do not require allocation to determine their impact on the cost object. For example, in a manufacturing context, the cost of raw materials like steel or fabric is a direct cost because it can be directly traced to the production of goods. On the other hand, indirect costs are not directly linked to any specific product or service, but still contribute to the overall operational expenses. These costs require allocation to connect them to particular cost items. Factory utilities, such as electricity and water, exemplify indirect costs. Though essential for operations, they cannot be attributed to any single product and must be apportioned across various cost centers. Variable costs fluctuate in direct proportion to changes in production levels or sales volumes. These costs rise or fall based on activity levels, reflecting the dynamic nature of cost drivers. For instance, in manufacturing, the cost of raw materials is variable because it increases with production volume. Similarly, in a service-based business, labor costs may also be variable, responding to demand fluctuations. In contrast, fixed costs remain constant regardless of changes in production levels or sales quantities. These costs do not vary with activity levels and are incurred irrespective of whether goods or services are produced. Rent for a facility or salaries for permanent staff are prime examples of fixed costs. Understanding these classifications is crucial for strategic decision-making, cost control, performance evaluation, budgeting, and financial reporting. The second core concept focuses on cost behavior dynamics. By analyzing how costs react to changes in production, sales, and other operational factors, organizations can gain valuable insights into their cost structures. Cost volume profit (CVP) analysis and break-even analysis are two critical tools that help organizations understand the interplay between sales revenue, costs, and profit margins. Break-even analysis identifies the point at which total revenue equals total costs, resulting in neither profit nor loss. This analysis is vital for determining the revenue needed to cover both fixed and variable expenses. Organizations can assess the risk associated with different pricing strategies and set sales targets to achieve profitability. Contribution margin analysis, another essential aspect of cost behavior, measures the difference between total sales revenue and variable costs. This analysis aids businesses in understanding their ability to cover fixed cost and generate profit. By focusing on products or services with the highest contribution margins, organizations can enhance their profitability. The third core concept pertains to accurate cost allocation and apportionment. In complex organizational structures, it is essential to model costs in a manner that allows for distribution among various departments, products, or activities. Activity-based costing, ABC, and overhead allocation are two methods that facilitate this process. ABC assigns indirect costs to cost objects based on the activities that consume resources. This approach provides a more detailed understanding of cost drivers, enabling businesses to allocate costs more precisely. In contrast, overhead allocation distributes indirect costs among multiple cost objects using predetermined allocation bases, such as machine hours or labor hours. While simpler, this method may oversimplify cost allocation if the bases do not accurately reflect cost drivers. Implementing cost models effectively requires the use of various software tools, ranging from basic spreadsheets to advanced data analytics platforms. Regardless of their complexity, the ultimate goal remains the same: to provide decision-makers with actionable insights into cost structures, profitability drivers, and areas for improvement. Understanding these core concepts is crucial for several reasons. First, mastering cost modeling fundamentals enhances resource allocation, allowing organizations to focus on activities that yield the best return on investment. Second, informed decision-making becomes possible when decision-makers have a firm grasp of cost structures, behavior, and allocation mechanisms. Third, optimizing operational performance hinges on understanding these basic concepts, enabling businesses to streamline processes and identify improvement areas. Moreover, a solid understanding of cost modeling principles fosters effective budgetary control. Organizations can monitor spending, identify discrepancies, and make necessary adjustments to financial plans, ensuring alignment with strategic goals. Additionally, cost modeling plays a vital role in risk management, helping organizations analyze and mitigate financial risks, which is particularly crucial amid economic uncertainties. Furthermore, proficiency in core cost modeling concepts enhances financial reporting accuracy and transparency. This capability allows stakeholders to gain insights into cost structures, performance metrics, and profitability drivers. Additionally, these concepts lay the groundwork for strategic planning initiatives, enabling organizations to forecast financial outcomes and develop strategies for sustainable growth. In a competitive landscape, organizations that leverage core cost modeling concepts are better positioned to adapt to market dynamics, respond to competitive pressures, and seize emerging opportunities. Compliance and accountability are also reinforced through a thorough understanding of these principles, ensuring adherence to regulatory requirements and ethical guidelines. As we consider the future of cost modeling, several trends and innovations are emerging. Technological advancements have revolutionized the landscape, providing businesses with new tools and methodologies to enhance accuracy and efficiency. Cloud computing facilitates the processing of large data sets, allowing for more complex cost modeling analyses. Advanced software applications streamline cost allocation processes, enabling organizations to focus on strategic analysis rather than repetitive tasks. Data analytics and artificial intelligence, AI, are also transforming cost modeling practices. Machine learning algorithms can analyze historical cost data to identify patterns and trends, aiding in more accurate cost forecasting. AI-driven predictive analytics tools anticipate changes in cost behaviors, allowing organizations to adapt their cost models dynamically. By harnessing these technologies, businesses can drive innovation and enhance performance. However, challenges remain. Rapid technological changes can create complexity, and data privacy concerns necessitate robust cybersecurity measures. The proliferation of data sources complicates integration efforts, requiring organizations to establish data governance strategies. Nevertheless, opportunities for innovation and collaboration abound, allowing organizations to develop customized cost modeling solutions tailored to their unique needs. In conclusion, effective cost modeling is essential for organizations seeking to optimize their financial management practices. By mastering the three core concepts of cost classification, behavior analysis, and allocation methods, businesses can enhance their decision-making processes, improve operational performance, and ensure long-term sustainability. As the landscape of financial management continues to evolve, embracing these principles will empower organizations to thrive in an increasingly competitive environment, paving the way for strategic growth and success.